Welcome to Just a Thought, Investing for Millennials. My name is Sam.
I'm Dominic.
And I'm Brett, and today we'll be talking about some more basic tips of investing, the dominance of Instagram, the fall of GE and brick and mortar, and the potential investing opportunities that come with small banks. So, Dominic, would you like to start us off with some investing tips?
Right, so what we're going to be talking about today is commodities. Now, Brett, would you like to explain what commodities are to the viewers?
Yeah, sure. So, what commodities are is when you own an amount of a substance, whether it be gold, soybeans, oil, whatever it is, but you don't actually have physical possession of it. It's like
like gold, for example.
Yeah, it's like symbolic. That's what I was going for. It's a symbolic ownership, and then you can buy and sell it depending on the global price of the commodity. You can hopefully sell it and make money off of it.
Right, so commodities aren't something that we personally recommend. We aren't invested in it. It's a little risky. The profits are small. It's hard to predict altogether. So we don't really recommend it, but in case of things like potential stock market crashes, a lot of times they'll say invest in gold. When they say invest in gold, it doesn't mean physically buy gold bars. I mean, you could do that, but it would be harder to sell actual gold bars. They mean invest in gold, invest in the price of gold, and sell it at a higher price because gold tends to be safe during a crash. And the price of gold should increase, and you should be able to make a profit on it. So if there's a potential crash that starts or you think is going to start, we recommend selling a lot of your riskier stocks and maybe investing some of it in gold.
Yeah, so it's important to note that commodities are also helpful because a lot of times there's less risk involved. So not necessarily with things like gold and oil that are pretty volatile, but you can invest in corn, soybeans, wheat, very basic commodities that generally increase as the population increases and the demand for food increases. So it's a good idea for retirement, just to diversify your portfolio a little bit so you're not so dependent on the stock market.
Right. So I think now we'll get into the big news, GE getting replaced in the Dow. So I think we mentioned this before on a previous episode, but this is obviously a big deal because GE is a massive conglomerate. It was once the largest company in the world, I believe, actually, or in the U.S. But recently, it's accumulated a lot of debt, and obviously as a company grows bigger, it's also harder to manage, and it's harder to be as flexible. So you've seen GE, it's taken a massive hit. Its price has fallen an insane amount in the past 5 years, etc. And it was replaced by Walgreens, and after this news, GE went and said we're gonna focus in on 3 real big sectors. We're gonna focus on aviation, power, and
Healthcare.
Healthcare, right? So,
Yes. So as you said, that the price of GE has taken a massive hit. 5 years ago, it was trading at approximately 23, and now it's trading at 14. So they're negative in the 5 year, big time. So obviously, it hasn't been a great investment. It also didn't help that about a year ago they halved their dividends. GE has been known for having massive dividends for the last couple centuries. They've had decades, last couple of decades. Almost two.
Columbus? Is that where he got all his money from?
Almost 2 centuries. So that also didn't help their stock price, and that was really the beginning of, I don't want to say the end because GE is such a big conglomerate, they're not going anywhere anytime soon, but that was the beginning of a massive downfall of GE. So now I think we should talk about how we feel about investing in GE. So Dominic, he actually bought GE yesterday, which was Tuesday, June 26th. And he bought it 2 days ago, the 25th.
Yes.
And it went up 8% against Sam's advice.
Right.
So that was a big win for
No one
Dominic.
could have seen it coming.
But I did. So
You didn't.
anyway, so I kind of use the logic of GE's been in the business for a long enough time, and it's got the experience, and it's still in a sector where energy is needed. That's a big thing they have a stronghold in versus a company like Sears, who has just gone out of business, they were a brick and mortar shop and they were being replaced by e-commerce giants like Amazon. So, anyway.
So that was my yellow lab barking in the background.
Still barking.
But their inability to adapt to a changing market has definitely hurt them. Their spin-off of their healthcare sector should help them out. Right now, I would give them a hold. I can't recommend buying it now. I don't see a huge correction in their future. It's because their downfall has been over such a long period of time. And definitely not a sell, just because I think in the next couple of years they could make a decent recovery.
Right. So anyway, continuing on that, I kind of use the logic of they still have a big enough stronghold in energy and enough assets in a still needed market where they should be due for a correction. I think after they were replaced by the Dow, it really hurt their price, but I wasn't really getting replaced by the Dow isn't necessarily a big deal. The warning signs were there. It doesn't really affect their business model. So I thought they were due for a correction, and sure enough, they were. Now, I probably say it's a hold as well. I think maybe it goes up another 5%, maybe even 10. 10 might be a stretch, though. But it's a risky now investment. I thought it hit 8, 9, maybe 10% now from when I bought it. I already sold it, but I think that was about as high as it was going to get. I'd say it's probably a hold now, so a 3. Sam, what are your thoughts?
Yeah, I just stay away from GE because they've been declining so much over the past couple of years. And they had good news when in a recent deal where they were able to get rid of some of their debt. So that's why the stock price went up like 8%. But in the long term, they're not going to make a comeback, I don't think. They're not going anywhere, but they're not getting any bigger.
They're not going to become the global superpower that they used to be.
No.
Right.
Okay, so now if we jump into our next topic, if everyone else is done with GE, Instagram becoming a massive social media platform from its stance 5 years ago, where it was valued at in the couple billions, now valuing at 100 billion.
100 billion.
So we just want to talk about that and Facebook's. Mark Zuckerberg's genius move to buy Instagram. Still, we feel that he isn't given enough credit, just because the media portrays it as like it was a good decision. We'll see how it goes. They have billions of users now, so that has been a great buy for Facebook.
Yeah. So Instagram, the exact statistics, they just hit 1 billion monthly users. Over the next 5 years, they could soar to 2 billion monthly users. Also, right now, Instagram, believe it or not, makes up roughly 10.5% of Facebook's revenue. And that number could go up to 16% soon. So they became a huge part of the company. I mean, without Instagram, Facebook would be severely weakened. So 5 years ago, buying Instagram for only $1 billion and sending the value all the way to 100 billion. Well done, Facebook.
Mm-hmm.
Right. So Instagram right now is obviously the golden goose of Facebook, and I think an important thing to also look at is Snap. So Snapchat, they obviously face major competition from Instagram, and with Instagram's massive growth and the amount of users it has, that's got to be troubling for Snapchat, who's right now they're starting to see a sort of a stifle of the amount of users they're getting on a monthly basis. The growth is slowing, and it's a little more concerning. So I would monitor that situation and be wary of Snapchat altogether.
Yeah. So Snap is currently trading at $12.82. Their day is up. Their day is down. Their 5 day is up. Their 1 month is up. But if you look at their 6 month and longer charts, they max out at a couple months just because they're relatively new IPO. They're just on an overall decline. They are they're just shy of half of what they started at, and I can say that I give it a sell, get out while you can, do not buy anymore. With a stiff competition like Instagram and Facebook, it's definitely hard to see a future in which they succeed.
So the thing about Facebook that makes it really interesting is Facebook, like the typical Facebook, not the company, but like the website, that has about 2.2 billion monthly users, and it is slowing down. But once you're at 2.2 billion, congratulations. And that's typically older people. A lot of younger people are using Instagram. So because Facebook owns both Instagram and Facebook itself, they're getting 1 billion active users on Instagram, with that number rising. And then on Facebook, they already have 2.2 billion active users. And it might rise a little more, but it seems to be stalling out. So now they're seeing a lot more growth with Instagram, but overall, Facebook is controlling a younger and older market.
Yeah, and once you hit 2.2 billion people...
That's like a third of the world almost. You're approaching that.
At that point, your growth is limited by the number of people with internet access.
Yeah. The world population
is your target market.
Yeah.
So overall, I would say invest in Facebook. I personally have a decent amount of Facebook. It's done well. I bought right after Mark Zuckerberg had his Senate hearing, because the share I took a tumble that day, because obviously it was bad news. But I definitely believe in their future. They're not going anywhere anytime soon. They survived this scandal, and unless there's another massive scandal, I only see them going up.
Yeah. So the thing about social media companies I like is, in the end, it's just a website. It's not like it takes hundreds of billions of dollars to make a website like Facebook, but getting all those people onto the same website and having the loyalty, like Facebook isn't going anywhere, because for that to happen, 2.2 billion people would just have to like agree to stop using that as their main social media, and that just won't happen.
Yeah,
it's just
at least not in the foreseeable future, and
right.
Especially. Today they were down, in the last couple of days they've been down, but that's mostly because of international unsteadiness with tariffs. But look, on the 6 month they're up. Everything past 5 days they're up, and I feel they're a solid investment going forward. Now, if we want to move on to the fall of brick and mortar stores, we touched on this.
In our first episode.
In our first episode?
Yeah.
So that was a couple weeks ago. But we just wanted to have a special segment about it, a midweek update, just because it's such an important topic to understand being an investor in this day and age. So some companies we wanted to talk about were obviously Sears, Sports Authority,
Toys R Us.
Yeah, Toys R Us. Best Buy as a counter example, just to take them as what these companies can still do to recover. And so, Sam, or Dominic, do you want to start us off on...
Right, so, for years, these brick and mortar shops, which are the stores with the physical locations, you go in, you buy your products there, Toys R Us was a good example. You bought the toys at the physical location. They dominated, the U.S. market and markets around the world for years, and many people thought they would never fail. Sears was an unbelievably massive company 30, 40 years ago. And, people thought that Sears would continue to dominate the world for years to come. But technology always, has a say in that. And it allowed companies like Amazon to start doing e-commerce, where they would sell their things online. And it was more convenient. You buy it, you don't have to leave your house. It comes, they ship it to you. Despite having to pay shipping costs, they were still able to give relatively cheap prices, and they were able to get these from all of these different manufacturers and sell it for cheaper prices as well, so that helped. And because of this, it's just made companies like Sears and Sports Authority it made them extremely hard for them to compete, because why would you want to go there and buy their retail products when you can buy them online on a company like Amazon for cheaper and more convenient?
Yeah, so Sears Holdings is currently trading at $2.17 a share. That's down in the 5-year from almost 50. So that's a huge fall. Their tire business is one of their biggest.
96%.
Yeah, it's absurd. No, not quite, almost. Their tire business is the biggest sector of business right now, and that really says something coming from.
I saw a Sears tire store the other day.
Yeah,
it was really funny.
They were like hanging on by a thread with their tires. It's a great case study of a company who didn't adapt to the changing marketplace. I don't know if any of the users or any of the listeners have any experience as a user of the Sears website, but it was slow. It was a dinosaur. Things would be out of stock, and they wouldn't update their page with recent prices. It's their lack of adaptation to the modern way of shopping, especially with millennials who have been proven to prefer online stores and not have as much brand loyalty. It's a great case study for other companies to follow, to see how they can avoid going the way of Sears and Sports Authority.
Right. And then with this clear emerging of e-commerce, you see companies trying to combat this. Two good examples are Walmart and Best Buy. Best Buy introduced price matching. They revamped their entire customer policy. They give 100% full refunds now, I believe, right?
Yeah, so on a very specific items they don't, drones and used items if they're refurbished, but that is essentially it's such a small percentage of their business.
Right.
It doesn't even matter.
Right. So they really have revamped the entire company, and it's you could definitely say it's succeeded. They've managed to adapt very well. They're still staying afloat. They're doing fairly well, actually. Currently, they're trading at $74. Their 5-year is up from.
It's currently trading at their 5-year was at 35, so that's a little more than 100% over 5 years. So even compounded, that's 10% compound interest annually, which has matched the S&P and the Dow or been a little bit behind it. But as a brick and mortar store, they've continued to grow, which is definitely a statement nowadays.
Right. Another
And then with Walmart, how they're fighting the e-commerce battle, they are just investing in e-commerce. So instead of trying to focus more on their brick and mortar stores like Best Buy is sort of doing, they're going over and fighting Amazon in India to gain a large market share of India before that market saturates, because it is an emerging market with the population is 1.2 billion people. It's a huge market. So they're going to try to focus on increasing revenues by going to India.
Yeah, so I'm just getting on Amazon's chart. I'm sorry, Best Buy's chart. Oh, Walmart. Third time's the charm. So Walmart has also invested in its e-commerce in the United States. They're not just going to lay down and let Amazon sweep them in the United States, just because India has so many people, but right now at least the money to be made is money in the United States. And they have also revamped their website, changed their return policies, had an Amazon Prime competitor. So between all those factors, Walmart is not giving up without a fight. So those two companies are good counterexamples to the whole fall of brick and mortar that can be used by other companies as a case study to see how they can survive.
Walmart's actually they're trading at $86 right now, and they're actually up $11 on the year. So Walmart's adapted well, like Sam said. They're going into India as well. They're also finding partners. They were in talks with Google as well to join together in fighting Amazon. And once again, you're kind of seeing this dynamic of companies trying to join together in a kind of Amazon versus the world kind of scenario, where all these companies are kind of trying to join together and fight Amazon.
And then the last type of brick and mortar store, you might not think of it as brick and mortar, but grocery stores are one that a lot of investment has been put into, and that should keep on coming, because grocery stores, you can't really do online groceries because the food would just go bad, so you can't really do that. The biggest grocery store would be Kroger. That's the main one. If you want to see how grocery stores are doing normally, just how Kroger is doing. Also, you see with Amazon how they bought Whole Foods for $17 billion. So the thing about grocery stores is they're going to try to make it a more pleasant experience. So instead of just going to the store, it's a more enjoyable place to kind of hang out and talk and meet people. So that's where the future of grocery stores is going. So they should be good in the long term.
Also, the Amazon Go stores, which would be the counterexample to why grocery stores are good and a good investment. The Amazon Go stores is, if you're not familiar, that is Amazon's grocery store that has 0 cashiers. So you just take stuff off, you scan your phone on the way in, you take stuff off the shelves, and you just walk out and Amazon bills your credit card just as it is on your normal Amazon account. So Amazon is also not giving up on the grocery industry. However, right now, e-commerce has had a tough time getting into the grocery store market.
Right. So building on that, the Amazon, the cashierless stores they're trying to build here. Amazon's struggling to make them right now. They're having difficulties with the scanners and being able to pick up your account, scan the item, and walk out. But they've already opened 2 stores. One's in Chicago, I believe, and I don't remember the other one is exactly. But Microsoft is actually trying to do that as well. They're trying to partner with some other companies.
I think it's Google, but I could be mistaken.
I think it is as well, and they're trying to work on making their own stores as well, which once again shows Amazon might have some competition. These companies, they're not going to let Amazon walk all over them. They're going to try and fight back themselves.
Yeah. So another thing we wanted to talk about is the investment potential that comes with investing in small market cap banks. So recently, the act that gave that put restrictions on banks to prevent another financial crisis.
The Dodd-Frank Act.
Yeah. It was originally implemented on banks with $250 billion worth of assets. I'm sorry. It was originally implemented on banks with $50 billion worth of assets and up. And then they just changed it, so now it's only on banks with $250 billion worth of assets. So now the savvy investor might be thinking that banks with $50 to $250 billion of assets have an advantage in the marketplace, and that's what we wanted to talk about.
So Sam, do you want to add anything on that?
So I think it's an interesting idea for investors, although I don't think there's really much money to be made from that idea, even though it does seem, in your head it seems like it would work. I'm just not so sure about it. If anything, I do know there's a lot of economists now saying that this looser regulation is looking very similar to what happened in 2008. So I think it's actually bad for the markets, very bad.
Right. So I personally, I don't think it's horrifically bad. There's some concerns about how it's kind of reflecting '08, but there's a lot of consumer protection policies that were put into place to prevent it from ever happening again. You're not. I think it's very unlikely to see obviously another housing bubble like that to similarly repeat again. And these banks, with this, as they loosen regulations, they might be able to get away with more about how they loan, how S&P and Moody's will rate their loan, their bonds and whatnot, and it could benefit banks. It'll allow them to have more flexibility in doing what they want, and it'll probably help them be more profitable. It's just not just companies with small market caps of 50 to 250 billion that aren't subject to this whole too big to fail Dodd-Frank Act dynamic, but altogether I think it shows a trend where in years to come banks will continue to have looser and looser regulations. While it might not be the '08 recession, if this continues, and the banks, there might be a similar pattern that you'll see continuously on for years to come, where there's a big crash or whatnot, something happens, banks have higher regulations, then as years go on it gets looser and looser, and then the same thing happens, and it's kind of a cycle you see in different forms. So you obviously want to watch out for that.
So I'll just, in simple terms, recap this episode. Banks, looser regulation, that could be good, that could be bad. It depends on what viewpoint you have from it. One side says repeat of 2008. The other side says there's too many regulations, so it won't make too big of a difference. Then there's General Electric. They're a huge company. They still have a market cap of around $120 billion. So they're not going anywhere, and they do have interesting prospects. But they have been declining pretty severely. And being taken off the Dow doesn't really directly affect them, but symbolically it doesn't look too good. Facebook Facebook is a powerhouse that will continue to dominate social media around the world, and with Instagram, they seem almost unstoppable at this point. So many billions of people that have so much loyalty to these social media websites. I go on Instagram all the time. I mean, it's great. So, Facebook is a company with that much control. How could they not be a good investment? Is my mindset. Also, brick and mortar. Yes, lots of traditional brick and mortar stores are falling, but if they can try to adapt to a new world, they have a shot at surviving.
Yeah, so we just want to end with our typical Warren Buffett quote. Eventually we're going to run out of these, but until then, we'll continue to quote Warren Buffett. And this quote is, "The investor of today does not profit from yesterday's growth." So from this quote, you can learn that just because a company historically has been successful, take GE for example, they will not necessarily continue to grow and be successful. I mean, that applies to all the brick and mortar stores along with GE. So just keep that in mind when you're investing and choosing your picks.
And don't forget to listen to us on the Apple Podcast app. Check us out on YouTube. Just a thought. Investing for Millennials. Give us a like. Give us a comment, please. We really appreciate it. And just thank you.
Yeah, we appreciate your feedback. This has been Just a Thought, Investing for Millennials. Have a good day.